All right, it's 10 o'clock. And I do see that we do have a few attendees already in the meeting. So perhaps let's get started. We do have a guest speaker and we strictly want to keep it to an hour. Welcome to our webinar today, where we are discussing a tax strategy for business owners and individuals with additional income. And we've titled it Preserve and Plan and Prosper. It will be presented by myself, Putana Mutsielwa, and I will be joined by Dinyiko Mhlari during the course of the presentation. And later on, I will introduce you guys to Ryan Kelly from Anchor Capital. All right, in terms of our agenda today, we've got the opening and the introduction. And then we're going to talk about what is provisional tax, who pays, what are the due dates, what are the pitfalls and the common mistakes, etc. Then we will start talking about what to do when you want to preserve, what to do when you want to plan, and what to do when you want to prosper. Then we'll go into Ryan's presentation, and then we'll take a Q&A at the end. For PSTM, this is who we are. We are a firm of chartered accountants and other accounting professionals. We're also registered auditors. We provide high quality accounting assurance, governance, tax, and advisory services within the space of within the business environment. We have over 15 years of experience across the private sector as well as the public sector. We're tech driven and agile. We've got a hands-on and a growth mindset. We are members of SAICA, ERBA, and SAIPA, and we're based in Johannesburg. In terms of the leadership on the right, it's myself, and on the left, it is Dinyiko, who I did mention will be then joining us to present a few things later. All right, so let's get into the meat of it. There's been a lot of talk within the media of late. I think there's always talk around tax, around SARS, as they say. Two things are certain in life, and that's death and taxes. Today, we're talking about that other one, certainty being taxes. So what you've seen, what you would have seen in the headlines, what you would have heard if you listen to the news, there is the recent story around Neil Carroll and how he paid himself 630 million and it was not paid as part of his employment package when it should have. SARS is also coming after Pepco boss and saying that you paid yourself 1 billion rand and you did not pay it as part of payroll. You cannot do that. We've seen the luxury car collections that are going up. I think actually the auction for some of the other personal items is today for Mam Kize. And they also, SARS is really clamping down and wanting to collect the cash that they believe is sitting in our pockets, as opposed to sitting with the National Treasury and with them. And then you've also got they wanting to collect 1.85 trillion, and I'm sure we've all received SMSs and emails, etc., etc. So when we see SARS, I think a lot of people just go into panic when they get a SMS or a phone call, etc. from SARS. It's always generally panic. Now, our webinar today is to help you to get some of those strategies that are going to help you to rather be proactive when it comes to managing your taxes, because as mentioned, it is one of those certainties in life. All right, we're going to get into now what is provisional tax. Dinyiko, you can take over.
All right, good morning, everyone. Can you hear me, Putana? Am I clear?
Yes, 100%.
Great. All right, great. Good morning, everyone. So you might be asking yourself, why are we talking about provisional tax on the 13th of November, 2025? You'll see as we go through the presentation, the timing is very, very important when it comes to taxes. So we need to be aware of the time frames, and one of them is even when to start planning for the provisional tax. Right. Now, when we look at what is provisional tax, simply put, provisional tax is tax that you pay on income that is not subject to pay as you earn. So anything else that is not taxed by your employer in the ordinary course of remuneration falls within provisional tax. What that means is that it is not a separate tax, it's not a new tax, it is income tax that you pay. The only difference is the manner in which you pay the taxes. So we're looking at the mechanism of paying over that tax. Very, very important. If you have income outside of remuneration, that income might be subject to provisional tax. We'll look further into what is included and what is not included. All right. Moving on to the next part, we spoke about it is income that is subject to, that is not subject to pay as you earn. What is income? There is a definition within the Income Tax Act that defines what income is. And very, very critical there is to note that income is the amount after deductions. So we're not looking at the amount that you've earned before deductions, we are looking at the amount post deductions. Very, very important here. It's important for you as a taxpayer to keep track of your deductions, to be aware of how much you can offset against the income that you have earned. Right. So if you are a taxpayer, you need to have those records because you pay tax only on the taxable income. We'll get into that a bit later on. Important for you to note, if you're a South African resident, you are taxed on all your worldwide earnings, meaning if you receive foreign income that is not exempt, there are certain exemptions, but here we're speaking about non-exempt income. You will be taxed on that income, right? So if it has not been taxed in a foreign state, you will have to register for provisional tax and pay taxes in South Africa. If you are a non-resident and you've got your source in South Africa, the income is generated in South Africa, very, very important. You will have to also pay tax on that income. Right. Moving on, I've mentioned that there are some exclusions or there's some exemptions. I've mentioned that if income is exempt, we don't speak about it because it is not subject to taxation. But from a provisional tax perspective, there are specific exclusions. So if you receive any tax-free savings or any interest income that is below the thresholds, the amounts that you see there, the 23,800, the 34,500, those are the exemption thresholds. If you receive income below the thresholds, you are then not subject to pay provisional tax on those amounts. Right. Now, very, very important, we need to understand who pays provisional tax, when do I pay provisional tax, and what should I look out for in making these payments of provisional tax. Right. Who is a provisional taxpayer? We said earlier on that provisional taxpayers is any person who receives income outside of remuneration. So again, we are focusing on individuals today. So if you're an individual who's earning an income that is not subject to pay as you earn, you are liable to register as a provisional taxpayer. If you're a director of a company or a closed corporation and you're a resident in South Africa, you are deemed to be a provisional taxpayer unless SARS deems you not to be. So rather play safe and assume that you are a provisional taxpayer. Do the assessment. We'll get into the assessment later on to determine, am I a provisional taxpayer or not? Very, very important. If you're a company or a closed corporation, you're automatically a provisional taxpayer. Critical for you to assess every single year. Any person informed by the commissioner that you are a provisional taxpayer. If you file your returns, you might see you file your return and suddenly you see a penalty or something for not filing provisional tax. It means that the receiver, the SARS commissioner, has deemed you to be a provisional taxpayer. It's very important to look at your returns. You will see at the bottom sometimes of your assessment, there'll be Section 89 quad penalties or interest for provisional tax. Then you have been deemed to be a provisional taxpayer. You need to then register as a provisional taxpayer, right? So very, very important here. As I've mentioned, if you receive any other income other than your salary, so what sort of income am I looking at here? So examples here, like we've said, the provisional taxpayers could be companies, business owners, freelancers, rental income earners, etc. So if you receive any income, director's fees that are not subject to pay as you earn, you've earned interest that's above a particular threshold, you've got rental income above a particular threshold, you're a freelancer, you've got a consulting business, and you are not paying yourself a salary, you may also have, you may be subject to provisional tax. you receive trust income or any other income, partnership income that is not subject to pay as you earn. So the income is wide, it's a variety. You have to assess all the income coming through into your business or to yourself and say, am I then a provisional taxpayer? And very, very important, when you look at income, we're not looking at income that has been physically received or only received. We're looking at income that is accrued. So we're looking at income that is due to you. So if an income has been declared to you, but is not yet paid to you, it still falls within income because the South African income tax works on an accrual basis and not on a cash basis. All right. We move on to determination. I said it's very, very important for you to assess whether you're a taxpayer, whether you're a provisional taxpayer or not. Now, let's start off with the beginning. If you are a company, including a CC or a trust, you are automatically a provisional taxpayer, right? If you are not a company, you come to this side. Are you an individual earning amounts other than remuneration? Right, so other than a salary, subject to pay as you earn. Do you have business income? Do you have rental income? Do you have consulting income? Do you have interest? Anything else that is not necessarily exempt income? If your answer is no, then you're not a provisional taxpayer. You continue filing as an ordinary taxpayer. If your answer is yes, you need to ask yourself the following question. Am I a South African resident whose income, whose total taxable income excluding remuneration and interest from local business is expected to be above 30,000 per year? We are looking at the taxable income, meaning the taxes, the income rather, after all of your deductions. So if your answer is yes, then, sorry, let's start with the no. If your answer is no, you're not a provisional taxpayer. If your answer is yes, you do have additional income and the taxable income, meaning my income minus all my deductible expenses is above the 30,000 per annum, then I must register as a provisional taxpayer. Remember, we are now looking at taxpayers who ordinarily are not excluded from paying taxation, meaning you have met the threshold for paying taxes already. Then when you go to the left, am I a South African resident? If your answer is no, I'm not a South African resident, then you ask yourself a question. Are you a non-resident whose income is not subject to pay as you earn? If your income is not subject to pay as you earn, your answer is yes, you're a provisional taxpayer. If your income is subject to pay as you earn, you are a normal taxpayer because pay as you earn has been withheld. Right. So again, if you're a non-resident, we're looking at the sources within South Africa. Very, very important. And I'm going to keep on harping on this point because oftentimes you find that taxpayers earn the income, but they do not keep records of the expenditure that you have incurred to generate that income. Right? Every single amount that you earn, generally you will incur some expenditure to it. So it's very, very important that you keep a record of all of your expenditure. In terms of the Tax Administration Act, a taxpayer is obliged to retain records for at least 5 years. So you need to retain records of all of your income together with all of your supporting expenditure for a period of at least 5 years. And very, very important here, I've mentioned earlier that the Income Tax Act in South Africa, the income tax system, is on an accrual basis. What this means is that even when we look at the deductions, we look at the deductions actually incurred. So meaning not necessarily paid for, but you have incurred that particular expenditure in the production of your income. Then we can look at examples of expenses that are allowable. So as you know, I did mention that we're looking at expenses, we're looking at income after expenditure. So very, very important before we get into what type of expenses they need to be. Very, very important. The expenditure must be in the name of the taxpayer. So if I'm going to incur an expenditure, I need to make sure it's in my name. Or if the business is incurring the expenditure, the invoice or whatever document is issued to the taxpayer must be in the name of that taxpayer. So the business must ensure I actually have incurred the expenditure. It's very, very critical. You cannot use the invoice of one business or one taxpayer against the deductions of another of another taxpayer. It's important for you, the onus is on you as a taxpayer to ensure that you have actually registered as a taxpayer, one, and number two, to ensure that all of your expenditure is actually in your name. Let me just go one step back. There's something I want to highlight actually. I'm going to slides back. Very, very important that the SARS system no longer registers you as a provisional taxpayer. The onus is on you as a taxpayer to assess whether you're a provisional taxpayer or not. Companies automatically are provisional taxpayers, but any other taxpayer, the onus is on you. Okay. All right. Now looking at the allowable expenses. As I mentioned, very, very important, ensure the invoices are in your name, all the deductions must be in your name. And very, very important when you're looking at deductions, we look at these direct costs, but for an individual, we'll also be looking at your retirement annuity fund, your pension fund, your medical credits. So any other expenses that are generally allowed for deductions within the Income Tax Act. So what sort of expenses can I deduct? We've just used two basic examples here. So on the right, we've got a property rental business, or yeah, property rental business, and on the other side, we've got a freelancer or any professional consultant, where we're looking at what sort of expenses you can deduct. So the critical part is that the Tax Act says you need to deduct expenditure directly incurred in the production or in the generation of that income. So if you're a property rental owner, you can deduct your levies, your agent's fees, maintenance and repairs costs, your insurance, rates and taxes, interest on the property, mortgage bond, vetting expenses, recovery of of expenses, invoicing fees, accounting fees, any other costs that you've directly incurred in generating that rental income. You'd see that this maybe this year there was an additional cost that I've incurred. You bring it in. Any other business expenditure, very, very important, they must all be substantiated or supported. If you're going to be making e-wallet payments, make sure that you've got a record of everything that you've paid and to whom you've paid. If it's going to be references, make those references. If it means you must keep an invoice booklet, rather do that. If it means you must for people to sign and say I've received this amount. If you're paying, especially if you're paying people that are working on your properties, but they don't necessarily have an invoice system or something, ensure that you're keeping track of those. You can substantiate it with your payments that you've made from your bank. If you are a freelancer or a professional consultant, we just said professional consultant, so it's wide. You could be anyone, you could be a personal trainer, you could be in production, you could be in marketing. It doesn't matter. You're a professional consultant, right? You're consulting in your profession. What can I deduct? I can deduct computer costs, internet costs, cell phone costs, travel costs, material costs, education and development. If I need to go for lessons, coaching lessons, I can deduct that. Stationery in your office, home office costs, equipment costs, professional memberships, meeting costs, and any other costs directly linked. Very, very important. The invoices must be, once again, in your name, and it must be directly attributable to generating the income that you are offsetting the deductions against. Right. Now, very, very important. Majority of us get to a point where we're like, okay, I don't know what I've done wrong, but we can at least try and avoid this, right? So there's some things that most these are very common amongst taxpayers. They're not unusual, but these are non-negotiables that we need to remedy. We need to ensure that we don't fall into these common pitfalls. Some of the pitfalls that you can look at there is failure to register. This one is one of the most common pitfalls. And the reason why we are saying let's try and avoid these pitfalls. Let's know what they are and avoid them, because you'll see later on majority of this, if not all of them, actually all of them have got consequences. As we all know, SARS does levy penalties, they do levy interest. They are empowered in terms of the legislation to actually do so. Right. So as a business owner, as an individual, please ensure that you do not fail to register for tax, whether it's provisional tax. In this case, we're speaking about provisional taxes. Assess yourself. Am I a provisional taxpayer? Yes or no? Register as soon as you become aware. Right. So SARS cannot penalize you if you say, I've assessed, I've now changed, and I'm a registered, I'm a taxpayer and I'm not registering. This is when I did my assessment and I'm aware of it. That's fine. But if you fail to register, even though you are aware, you can get penalized for that. Right. Underestimating and non-declaration of income. Again, very, very common. People will say, I don't think I'll generate this amount of money. Then somehow the last 2 months of the year, the income goes very, very high, and you still want to stick to the old predictions, or you haven't revised your estimates. Very, very important. You must ensure that you do not underestimate your taxes. So there is room for you to maneuver within the SARS system. If you're a provisional taxpayer who's an individual, you have to ensure that your estimate is at least 90% accurate. So you've got a 10% margin of error if you are making provisional income of less than 1 million. If your income is above 1 million, you have to be within 80%. Failure to do so may attract penalties. Right. So SARS can levy penalties on the difference that you ought to have paid, and generally the penalty is about 20% of the shortfall. When you look at reporting, generally, as I mentioned earlier, most taxpayers do not keep record of their expenses. Important for you to do so. Late submissions, again, penalties may be levied there. Non-payment, you know you've got an obligation. Rather engage SARS and make an arrangement. Do not ignore the communication and not pay SARS. Make an arrangement. Approach SARS and work out a plan together with SARS. Incorrect or outdated details from SARS. Oftentimes, communication will be issued. However, it's not reaching the intended recipient. Very, very important, the deadlines. We've just put two critical deadlines there, but there are other deadlines. We'll get into them just shortly. Important for you to know as an individual, the 31st of August, I must file. The 28th of August, I must file. These are the two minimum tax returns that are required. There is an optional third return that you can file. This optional third return is filed within 4 months, not within 4 months. It's filed and you need to make a payment, a third voluntary payment within 6 to 7 months after the year of assessment. So if it's, for example, if it's February, you've got 6 or 7 months. 6 months applies to companies, but for companies and individuals with a year end of February, SARS allows you to pay by September, which means it gives you 7 months, right? So if you think I've underdeclared, or I think I didn't do my estimate correctly, you revise the estimates and you get to, I need to top up, you can do so within that 7 months. And then a final income tax return is required to be filed 11 months after the end of the assessment, meaning at the end of January. So simply put, this is our provisional tax year timeline. I'll be very quick. So when you look at this timeline, we look at, for example, this 2025 that just that ended in February this year. You needed to have filed your final income tax return by January of 2026. Right. We are now in 20. So that means that you've got between now and January to file your return. You had up until September this year to make the third payment. If you didn't do so, you probably, and you're over by that 10% margin, as I mentioned earlier, 20%, you may then have penalties that can be levied on you. But for everyone else, if you are fine, you have up until January this year, 2026, to file the return. So every single year, SARS will gazette when the due dates for filing returns. We're all aware that we don't file taxes on the same day every single year. It's the same thing for provisional tax. So SARS will say the final provisional tax for 2025, for example, is now the 19th of January, 2026. This is gazetted every single year together with all the other taxes. So when they say income tax, due date, same thing for provisional tax. Right, so for next year, we need to ensure that by September 2026, we have made that third payment for 2026 assessment, right? Make that last payment, and by January 2027, we pay the payment. So every 6 months, and then the final return 11 months after the year end, and 7 months we can pop up. Very important timelines. I've touched on this a little bit, so I won't go into too much detail. But as I mentioned, if you do not adhere to the timelines, you're risking getting penalties. You're risking being auto-assessed. So SARS can estimate in terms of the Act. SARS is empowered to actually estimate. If you do not file a return, SARS can actually do so on its own. And as I've mentioned, compliance credibility can be damaged. You can get a shock in terms of how much you need to pay, stresses, and you lack peace of mind. So I think I'll stop there from my side, but just perhaps to highlight one thing before I hand over to Putsana to take you through the strategy. Very, very important and a useful tool is to ensure that as a taxpayer, you are aware of your tax compliance status. If you don't know how to do it, get in touch with somebody who can assist you in terms of assessing your tax compliance status so you can see where you are from a tax perspective. Putsana, let me hand back to you to take over the strategy. Thanks.
Right. Thank you, Dinyuka. Okay, so we are now going to start getting into the what should I do, how should I do it, etc. So when we're speaking about preserving, we're talking about safeguarding compliance, your records, your financial base, so that nothing leaks through, whether through errors or through oversight. So we don't want to plead ignorance. We want to be informed, and we want to then start preserving what needs to be preserved. Number one is you need to identify all of your income sources. That 150 Rand that comes in from the royalties from the book that you wrote 10 years ago, even that counts. So identify all of your income sources. Determine if you are a provisional taxpayer. We've done that test earlier with Dinyuka. If you need to go back, please do that and check. And then keep all the records of your income. Keep accurate records of your expenses. As mentioned, there are requirements. And so, if there's an invoice that is addressed to me, you cannot take that invoice and then want to claim it as a business expense or for yourself in your personal capacity, or you've got a Vodacom invoice maybe. You cannot then come and take that invoice and say it is for my business. Okay, there are limits to these things. Find out what the right thing to do is. Be aware of the tax timelines. We've gone through those. If you are employed, rather than go speak to your employer and ask for voluntary over deductions, this then makes sure that you don't have a huge liability at the end of the year. Set aside some monthly amounts periodically to meet this obligation at the time when you need to do so. So you can create a separate savings account or something to that effect. Most banks offer those facilities. The goal here is to preserve that compliance, to preserve your personal credibility, your business credibility, as well as liquidity. There's nothing more annoying than getting a tax bill that says 300,000 Rand and you don't even have anywhere close to that 300,000 Rand in your bank account. Don't lose money to penalties, okay? Let's make sure that you are planning. SARS is very, very efficient with levying their penalties as well as their interest. You don't want to lose money to that. You don't want to lose money to poor record keeping where they disallow you with expenses because you did not either keep a record or you didn't get the invoice to be recorded in the correct name. You also don't want to be caught by timing errors. Be aware of what is due when. Right, when it comes to planning, we are talking about proactive structuring, okay? We don't want to sit here and say that 300,000 Rand bill could have actually been 150,000 Rand if we had done XYZ. No, we want to do XYZ before we get levied with that 300,000 Rand. So make sure you're doing your proactive structuring. Make sure you are aware of what's happening in your business in terms of the forecasts. What are you expecting to get? What are you expecting to invoice? When, etc. Optimize your tax position to align with your goals. Tax is the law. But that does not mean that there isn't room for us to maneuver as taxpayers. There's a lot of room for us to maneuver and still stay compliant. Make sure that you do all of that. Prepare your budgets and your projections. Prepare your tax estimates in advance so that you are then aware of what is going to be due when the time comes. You need to review your entity structure or even just your group structure if you do have such a thing, and make sure that it is still optimal for what you are actually doing right now and also what you are planning to do. So you've got a strategy that goes into the next 5 years. Is the current structure that you are making use of actually responsive to what you are wanting to do in the next 5 years? You need to review your business income, and then, if practical and where it is possible, offset losses versus ring fencing. So, for example, earlier we had an example on somebody who owns a property. Your property is new, let's say. And so when your property is new, obviously the interest bill is quite high. You've bonded that property, you're Airbnb-ing it, or it's a long-term rental, whichever one it is, it doesn't matter. The interest is quite high. So that interest that you incur, it's an allowable expense, as we discussed earlier. Bring that in as a deduction on your tax return, where you've got your salary, you've done everything that you can do in terms of your salary. Let's take that income and offset it against, or that loss rather, from the property, and offset it against your salary income, because at a later stage, when that property starts turning around and making a profit, you're also going to be paying that profit. It is allowed. Then review your effective tax rate trend. So that is simply just a calculation that we do on an annual basis that says last year my effective tax rate was 38%. This year it's 39. Next year it has moved to 42. So now the question becomes, I can see where the trend is going. I am now paying higher and higher in terms of my taxes. Is the structure then still the best way for me to structure? You need to plan for efficiency as well as have the foresight. You need to structure and forecast so that you can keep more of what you earn. That way we're reducing leakages, and we don't need to, we can then start to preserve some of that wealth that we are all building towards. Then, when it comes to prosper, use tax efficiency and strategic structuring to build long-term wealth and sustainability. Maximize those allowable deductions. If you're not sure, that's what we are here for. Ask us, I have this expense. This is the type of business I'm doing. Would this be allowed? Okay. Leverage your tax advantaged investment vehicles. You've got your retirement annuity. Obviously, this is for people who are paying themselves a salary as business owners, or even if you have a salary from your employer and you've got other income. Maximize on what is available as a deduction for your retirement annuity, your tax-free savings, etc. Inform yourself as to tax advantaged investment vehicles, what they are, how they work, how they affect your tax calculation, etc. And that's what our guest is going to be speaking more on just now. Time your income and your expenses strategically. So, for example, if I know that I'm a provisional taxpayer, it's now November, and I'm due for a laptop, right? I need to buy a laptop. I'm a consultant. I can actually, instead of deferring the purchase of my laptop to next year, because I'm aware and I know roughly where I am in terms of my taxable income at this point in time, I can rather buy my laptop now at this point in time as opposed to waiting for next year, so that I can be able to claim that deduction now in this current year, time value of money and all of that. Reinvest all of your post-tax profits into income generating or capital growth assets. One of them is obviously your business, guys. When you start a business, you can reinvest into that business so that the capital value of that business is also then growing. Diversify your entity structures for long-term planning and protection. You've got a company, that's for your business growth, that's for income splitting, that's for your corporate deductions, etc. You've got a trust for asset protection, for estate planning, and for intergenerational wealth transfer. All of these are tools that are obviously very legal that you can make use of, but you've got to have the right structure in place. Do not just go and say, I heard I must open a trust, and therefore you're running off to open a trust. Meanwhile, the trust is not responsive to your needs and your personal circumstances and your family, etc. Investment holding company, you can separate all your incomes or rather your passive income from your trading risk. There's a specific structure that you can put in place for that to make sure that the high risk assets are separate from the low risk assets where you just bought shares on the stock exchange, let's say. Partnership and JVs, these are for flexibility in profit sharing and cost allocation. Obviously, all of these must be responsive, right? We don't just go and register a company because we heard it's the right thing to do. We get advice, and then we get advised that, okay, company may be the best way to do this, and that's what we then go and do. All right. What you also need to do is you align your income streams to the most tax effective vehicle. So when you've got a salary, there are certain deductions that you cannot claim in your salary. But if you've got other income, then the advice may be maybe register a company for this income. And obviously there are also requirements that your company may have to meet in order for it to actually be meeting the requirements that you are wanting it to meet. We cannot, for example, claim your rates and taxes in for an individual tax return where somebody is not running a property business, it's just a salary. But what we can do is we can maximize on your retirement annuity fund, for example, up to the, I think it's 350,000 Rand maximum that's allowable by SARS. You need to track your after-tax returns to measure real wealth growth, okay? It's great that you're running a business, but what is the wealth that we are being able to retain in this business on an annual basis or every 6 months, whatever that measure is for yourself? You need to make sure that you are aware of it. Consult a professional like PSTM for structuring, compliance, as well as optimization guidance. The goal here is to build sustainable, tax-efficient wealth using the right structures to preserve capital, to protect assets, and to prosper across generations. I think most of us want to do that and make sure that our children are starting off not on point zero. All right, so your structuring options, common wealth building vehicles are your founder salaries. You must pay yourself a salary when you start a business, guys. You've got your entities, trusts, companies, you've got asset holding companies, and then we've got the various investment vehicles that are available on the market. Tools and support to help you to stay on track. Make sure you're using accounting software. If you're still very small, I think it's okay to keep that invoice box. But the moment things start getting out of hand, I think it's important that you make sure that you use what is available, what is efficient, etc. And we can definitely assist you with that. Make sure that you're using project tracking software where you've got various projects running at the same time, just so that you can be aware of what are the incomes on this project, what are the expenses on this project, and so that you're not cross-subsidizing projects. You want to make a profit on every single project that you undertake. Make use of SARS e-filing. I think most of us are using e-filing as opposed to trying to go into the branch to file our returns. And SARS has made themselves available via emails, via the phone, the call center, etc., as well as via e-filing itself. So make use of that. It is a tool available as well. And make use of PSTM as well, advisory. We have been working with SMMEs for a very long time, and we very much understand what SMMEs go through, and we can definitely provide you with that advice. All right, at this point, I'm then going to hand over to Ryan. Ryan's going to take us through some of those tax-advantaged investment vehicles, especially looking at entrepreneurs as well. Ryan, are you ready?
Yes, I am. Thank you.
Right, I think you can take over.
Perfect. I'm just going to share my screen. Okay. Can you see that?
Yep, we can. Thank you.
Perfect. Well, yeah, thank you for the opportunity to present here and for everybody attending. And that was very informative from you. So just to start off, so we're Anchor Capital. Some of you may know us, but for the rest of you that don't, I like to just start off with a bit of a snapshot view as to who we are and what we can do for you and your clients. So Anchor was started in 2012. It has over 281 billion assets under management, makes us one of the largest independent advisors in South Africa. We have over 550 staff members. We're geographically located in all the major cities in South Africa, so Joburg, Cape Town, Durban. We also have offices in Mauritius, as well as through a recent acquisition of a company called, you'll see at the top there, Credo, which is based in the UK, which is a business of 30 years in the making, over 20,000 staff, 20,000 clients. And basically that spearheaded us into a offshore market and to be a global player. Just a bit about myself then. So who's on the other side here? So I've been at Anchor for nearly 4 years now, previously at RMB and Investec. I have a certified financial planning a postgrad degree, as well as specialized in investment planning. So I have over 15 years of financial experience and in this space. Maybe just to paint a picture as to Wild Dog Capital. Wild Dog Capital is a division within Anchor Capital that I sit. We strategically partner up with accounting firms like PSTM, and that's why I'm included in this presentation today. And what we do is we help their clients and their staff, if need be, with their wealth management, their wealth preservation, and their wealth growth. It's a strategic alliance and that works very well in this industry, and we have over 150 accounting partners in South Africa that are partners in this space, as well as now branching out into the UK. If there's any questions during the presentation, please feel free to ask or put in the chat box. Just a bit more about Anchor and our investment philosophy and process. So we meet as a sales force on every Tuesday and every Thursday to go through any companies or industries that we have exposure to within the funds that we then put together for our clients. We look for good growth companies that have good track record, good management styles, and at a fair price as well. So we're not looking to get exposure to companies that are startups, because we believe that that's not where the money will be made for our clients. So this is just a bit more on the investment process and philosophy, as I've kind of highlighted to you now. Just some of our products and services. So we have a wide range of products and solutions for clients. So we can assist clients in their individual capacity, in their entities or trusts. We have no minimum, no maximum requirements. We have local products and solutions, as well as offshore products and solutions. We have tax efficient solutions as well, which has been mentioned already in this, but like your retirement annuities, your tax-free savings, living annuities, endowments, wrappers. So we really come here to customize and make bespoke solutions for clients, because we believe that no client is the same, no need is the same, no goals or objectives are the same. So it's important for us to understand what the client is looking to achieve, what their business is, and how we can assist and put a bespoke solution together for them accordingly. This slide just represents our products and our solutions. So as you can see, we have a wide range of solutions there, different funds, starting from low risk highest return, like our core income fund or our flexible income fund. As you move up the risk spectrum into a moderate risk profile, better returns, but obviously risk is increased. And then it goes all the way to the top end there for highest risk, highest return, which would be more equity based. So you're looking at your offshore equity feeder fund, for example, our worldwide opportunities. So this just kind of showcases to you that we have all solutions across the board. What's also nice about Anchor is we're not tied agents, so we can build a investment portfolio for clients that is suited to them. And if we don't have it in our suite of products and solutions, we can still add it in there. Yeah.
Can you just make it a little bit bigger? I can't see the lettering.
Okay. That a bit better.
Yeah.
Yeah. So yeah, just to continue that is that we have end-to-end for clients depending on what they're looking for. We're not tied agents. We can include other funds, other solutions in there if need be. We obviously back our products and solutions because we have the expertise. We have over 40 analysts that work within the Anchor group that analyze these different companies, these different industries on a daily, weekly basis. And what's nice about that is that feeds through to these individual funds because the portfolio manager can then actively manage the fund based on the information that we receive from these investment analysts, as I said, on a daily and weekly basis. So the active management side is very important. We look to diversify clients' investments to ensure that they can weather the storms. If there's decreasing interest rates, for example, or increasing interest rates, or there's geopolitical risks, whether that be in South Africa or abroad, we ensure that the portfolio makeup can weather those storms and get a consistent return for clients over time. There's also liquidity in these investments as well. So we really make sure that we understand the client's needs to say, what type of liquidity would you need? Do you need short duration, medium or long-term liquidity? And we design the portfolio and investments around that. So this is some of the products and solutions. So I'm just going to zoom out so you can see it. Or do you need me to stay zoomed in to see the words now?
I think it's fine now. I think those ones were just too small, but 2 minutes, Ryan.
2 minutes. Okay, so products, so tax-free savings, as I mentioned before, 36,000 Rand per year, 3,000 Rand per month per tax year, 500,000 Rand per person per lifetime, and all the growth is tax exempt. So once again, these are just some of our products and solutions. I want to rush through a bit because I want to get to one important. So this is our bespoke investment plan where we can tailor make it for you. Retirement annuities, as mentioned, the benefits of having that within your name for your retirement savings. It is Regulation 28 compliant. You are able to make once-off withdrawals from it, but it really encourages clients to save for their future. Pension preservation funds, if you've been at an employment before, we can take over those. And we're also platform agnostic, so we can use Old Mutual, 91, Allen Gray, and the likes. Living annuities. I just want to get down to the one main example, which I think will be quite important for our audience today. I will send this on to you, which was shared by Putuning and Taniko. Share portfolios, collective investment schemes. So we have a range of products and solutions. So sorry for rushing through it, but this is quite a unique product out here where interest, income, and the tax on that is quite, nobody really wants to pay extra tax if they don't have to. So this is a tax efficient solution where the interest is rolled up within the investment. And because of the nature of the investment and the underlyings and the long-term view that the investor has, this is viewed as capital in nature. So the two examples that I've put together is one as an individual, and I'll just go a bit bigger there so you can see it. So this is if it was in an individual name, 5 million Rand, for example, as the investment. The fees that are included in this product known as an e-bill with the advice fees and comparing it to if you had this at a bank account and the return that you would get at a bank. So the idea is by having it in this investment solution, we are able to roll up the growth in it, and only on exit is a capital gains or CGT event triggered. That's beneficial if you're at a higher tax bracket like 45% in the personal name versus the 18% now as capital in nature. And then the last one, since I believe quite a few of your business owners, this applies also in a business scenario. I've just used 5 million again as a base case. That you don't have to have that amount. Obviously, the larger the deposit, the better the overall outcome is because the gap widens. Fees are the same as I've mentioned, but now with CGT at 21.6% compared to 27% for company in nature. And now the difference between that over a 5-year period, you're looking at a total savings of about R1 million based on this information staying static over that period of time. Putting, did I make it in time?
Yeah. Yeah, you did. Thank you so much.
So quite
Thanks,
a few
Ryan.
products and solutions there, but I will share this with you that you can share with your clients. Obviously, my contact details if anybody would like to get in contact with me to talk through this in more detail, and obviously through our relationships with PSTM.
All right, thank you. So, guys, just to finish off, and if you have any questions, please let us know what those questions are. As I mentioned, what we then do have is, yeah, we've been through the guest speaker. You can just put them in the chat. I'm not sure if anybody can put on their mic, but just to round us off, how we can then assist you as PSTM is that we offer you strategic support with your taxes. Okay, we estimate and we calculate your provisional as well as obviously your final tax return that you would have seen on that timeline that Dinyiko was going through. We manage your SARS submissions and we comply with the deadlines. If any of our clients are here, you would know that on a certain date, you can expect an email that tells you that here's your calculation. This is how much we can expect to pay. Please make sure that you've got this amount in your bank account, etc. And we provide ongoing advisory for tax efficiency. So we can put a structure in place today for yourself, but 3 years from now, you're married and you've got 2 children, and that structure is no longer then fit for purpose for who you are 3 years from now. So we're always offering that ongoing advisory and making sure that what we've put in place is actually responsive in terms of the strategy that you would have told us, this is where I'm trying to go with my business. And that obviously includes the investment vehicles as well. So what we want you to take away from today's webinar is to shift your mindset. Okay, all the negative talk on the media, the social media, etc., around tax, around SARS. We don't want you to be caught up in that drama. We want you to be able to sleep at night. You know that I'm compliant. There's really nothing here that I have to fear because I've adopted a strategy for my taxes. I've been helped by PSTM. We don't want you to treat tax as a grudge payment, because when you treat it as a grudge payment, that's when you are reactive. You're going to wait until you've received 7 messages from SARS in one day, and then you feel like they want to take me to jail. Please don't wait for that time. Preserve your compliance. You need to plan proactively and prosper strategically, because good tax planning does not just save you money. It builds sustainable, investable, and transferable value, which is what we are doing within our businesses or even with the salaries that we earn. That's what we want to do. Otherwise, this is then how you get in touch with us. These are our social media pages, but if you just scan that code, it will take you through to the various options that you've got to stay in touch with us. You can subscribe to our mailing list, or you can follow us on social media, etc., and look out for future webinars as well and events that we attend, etc.